Okay, Professor Jim Schultz here from my Finance 512 class. As we talked about in class, as part of kind of the hybrid nature of this summer session, I wanted to go ahead and do a video for the futures section. And I wasn't quite sure how I wanted to handle this in terms of what I wanted to cover, because there's a lot of things that I could cover in regards to futures. And I decided to kind of stick with the theme that we've had thus far this semester, and I really like this theme, in that I'm kind of moving right to the practicality of a lot of the things that you guys are trading. So like these different instruments that I'm having you guys learn how to trade, like stocks and currencies and options and now futures, rather than go through some of the theoretical stuff that I really don't think in my experience is going to be that useful for you guys right now, I want to move into the more practical nature, the practicality of trading futures. Now, for those of you that are going to potentially end up in a let's see. Well, I was going to say if you're going to end up in some kind of a portfolio management career or a trading career, you'll need to know the theoretical stuff. But based on my conversations with people in those positions and my own experience, actually, no, I think this is actually more valuable. I think the practical nature of it is more valuable. Understanding the theoretical stuff is obviously important, and you can never go wrong with that. But we only have so much time and so many resources, so I kind of want to go ahead and do the practical stuff. So let's go ahead and get started. Alright, so here's the first thing that you need to know about futures. I want to make a couple of general comments, and then we're going to move right into, I want to look at, I've got 3 underlyings here on my sheet that I want to take a look at and kind of describe kind of the ins and outs of each of those guys. Number 1, much like with options, futures are very highly leveraged products. Now remember, with options, what did we see? Options allow you to control 100 shares of stock, more or less, with a lot less capital than it would require to buy or short those 100 shares of stock outright, right? So that's very advantageous because it's a much more efficient use of your capital. Well, futures offer you the exact same thing. With futures, you're able to control, in the futures world, it's called notional value. You're able to control huge notional values in terms of contract sizes with only a fraction of that contract size. And I'm going to show you exactly what that looks like here in just a couple of minutes. The next thing I want to say is every futures contract, kind of like options, right? Like with options, every option derived its value from the underlying stock, right? Well, every future derives its value from the underlying asset or collection of assets that the futures are derived from. That's why when you hear options and futures referenced, a lot of times they're simply referred to as derivatives because they are derivatives of some underlying asset. Well, futures are the exact same thing in terms of having some underlying instrument lying beneath the surface. The next thing I want to say is futures are very different from options from the standpoint of, as I showed you guys last class, with options, you're able to actually give yourself a mathematical, statistical advantage in terms of probabilistic outcomes, in terms of your win rate, in terms of potentially your P&L, if you focus on things like implied volatility, like I kind of alluded to in class. You're able to position yourself really well, statistically speaking. With futures, there is no statistical edge. So this is just a pure direction play. Just like buying stock. If I buy stock, I need the stock to go up to make money. If I short stock, I need the stock to go down to make money. It's the exact same thing with futures. If you buy a future, you need its price to go up to make money. If you sell a future, you need its price to go down to make money. There's no time decay. There's no waiting until expiration. There's none of that happening here. And so it's important that you guys recognize that difference before you kind of get started. So let's go ahead and take a look at a few of these guys. The first one I want to look at is /E, and if you hear my dogs in the background, we have 3 Malteses at my house right now. The 2 that are mine and 1 that is my sister-in-law's, and so we've got a little dog fighting ring going on in the back, and it's just a bunch of Malteses going after each other. So you might hear some commotion. But the first one I want to go through is /ES. And so this is probably the most actively traded future in the world, and it is the future on the S&P 500. And so I've already kind of got it up on my screen here. I'm going to get rid of this just to give myself a little bit more room. So this is /ES. This is the E-mini S&P index future. E-mini just means it's a smaller contract. There's also the SPX futures that are like the big boy sized S&P futures. Most traders trade the E-mini contracts just because they offer you a lot more flexibility, and they are already big enough, as we're going to get into here in a second. So if you just type in the /ES in your little pop-up box here, it's going to take you to kind of the trade page for the E-mini S&Ps. Now, here's the first thing you want to recognize. For futures, every futures quote has the / and then the two characters that represent kind of the base symbol. And then they have another character that represents the month that contract expires. And then they have another symbol that represents the year that contract expires. And so when you just punch in the base characters looking for a quote, Thinkorswim is going to give you the 2, 3, 4, or 5 upcoming expiration cycles to trade, and it will tell you what the actively traded contract is. This is an extremely nice feature of this software that you guys don't really know. You guys wouldn't know either way because you're not active traders yet. But as someone who actively manages my portfolio all the time, this is very, very helpful because you want to be trading the contract that everyone else is trading. You want to be trading the contract that is liquid, that is active. It makes it easy to get in and out when you want to and when you need to. And as we're going to see here in a minute, it also offers you the smallest bid-ask differential. So this right now, the active contract in the E-mini S&Ps is the September contract. The E-mini S&Ps and many of the financial futures like S&P, like NASDAQ, like Dow, they trade on a quarterly cycle, which simply means, you know, the contracts, how do I want to phrase this? There are new expiration cycles every quarter. Other contracts trade on a monthly cycle, kind of like options, right? But with futures, it's different. Each future kind of has its own, it's kind of in its own world, right? Options, there's kind of some standardization across the board with all options. With futures, it's not the case. With futures, every future is its own animal. Every future is going to have its own unique characteristics that you need to be aware of if you want to trade that product. And so with the E-mini S&Ps, we're looking at quarterly cycles. The actively traded month right now is September. That has 78 days until expiration. Now, one of the things about those contracts and the fact that they're all unique, the expiration days for each contract is not standardized. Like for options, it's always the third Friday of the expiration month. For futures, it's totally different. The E-mini S&Ps might be one thing. Oil is going to be something totally different. Gold is going to be something completely different from that. And you just have to be, literally have to be aware of what you're doing. And Thinkorswim really makes it easy on you. Okay, so the E-mini S&P right now is trading at 2068.50. Now, remember, these are futures instruments. So these are forward-looking instruments. So you might pull up the actual S&P 500 index right now, and I don't know where it closed today. I'm actually not sure. But the S&P 500 index, I believe, closed above 2068.50. It might be around 2075 or something like that, 2080. I'm not sure what it closed at today. But essentially, the September month being lower suggests that the market is expecting, if they had to make a choice, the market participants are expecting, based on their buying and selling of these futures contracts, that the S&P 500 is going to go lower in the future. And when you see, if you look out to, you know, this is going to be, I don't remember what U is, but U is, I don't remember what month that is. That is September 2016. Yeah, I should have known that because that's September 2015. So September 2016, you see those contracts are trading for around 2040 or 2054. That's a huge spread. And so maybe a midpoint of 2047 is kind of what we're looking at right there. And so you can see that the market is expecting the S&P 500 to go down. And this situation, essentially, when you look at a futures market and you look at the various contracts that are available in a futures market, you're always going to see some relationship. You're either going to see the prices rising over time, or you're going to see the prices falling over time, which is what we see here. You could see the prices remain flat over time. That's a little bit more unusual than the first two. Prices falling over time in the futures market is called backwardation. If you see prices rising over time, that is called contango. And these are just some futures terms to describe the pricing relationship as you go out further and further in time. So now the S&P 500, the E-mini S&P, this is a, if you look at this contract right here as a bid of 2060 and a quarter, 2068 and a quarter, ask of 2068.50. So it is a quarter point spread. Every point on an E-mini S&P contract is $50. So that means $50 change in P&L. So that means every quarter point is $12.50. Now, if every point is $50 and the contract's current quote is about $2,000, that means the notional value that you are controlling with this contract is about $100,000. Okay, and so you need to be aware that if you buy one contract, that is $100,000 in notional value. It would be the equivalent of buying 500 shares of the SPY index, which is selling for about $200 a share. So just to give you some frame of reference and some kind of parameters to operate within. But so it's a $100,000 notional contract size. But watch what happens. If I was going to go to buy one of these, just buy one future contract. I'm not gonna submit this order, but I'm gonna bring up the confirm and send box. If you look, well, that's because I already have a short position on. So let me say if I was gonna add to my short position. So if I was gonna short another E-mini S&P, it's only gonna cost me $5,000 in buying power effect. So essentially, I'm able to put up about 5% of the contract's value to control that contract. That is an enormous amount of leverage, and that's kind of what I wanted to make you guys aware of. And so that's kind of what I meant earlier when I said these products are highly leveraged. So typically, the margin requirements are between 5 and 10% depending on the underlying instrument. So that's the E-mini S&P. Let's go ahead. Let's look at something different. Let's look at bonds. And this video is already getting kind of long in the tooth, so I'm going to try to speed things up a little bit. But I went through all that general stuff which I wanted to go through. So bonds also trade on a quarterly cycle, and everybody is trading September. Why is everybody trading September? Well, number one, it's telling me it's the active month. But number two, and I didn't show you guys this on the S&Ps, but you can go back and look at it. Look at the spread in September. It's one tick wide. Look at the spread if you wanted to trade December. That's an enormous spread. Now this is the /ZB is the U.S. Treasury bond. It's the long-term bond in the futures market. This is the easiest and simplest way to get bond exposure in your portfolio, whether it be in our virtual game or in your actual portfolio in real life, right? Like in 311 or 680, you learn about corporate bonds and you learn about all the bond pricing that goes on with corporate bonds. But honestly, I've been doing this for a long time. It's kind of difficult to invest in corporate bonds. It's a bit of a headache, let's say. But if you want some bond exposure, it's very simple to just buy or sell a bond future, and then you're able to achieve, that bond exposure rather than going out and buying a bond in Walmart or a bond in Coke or a bond in Pepsi or whatever. But you have to learn about that stuff first, because I think it's easier to learn about corporate bonds. Now, bonds, they're trading for 149.07. Now, the bond market has an odd quoting convention. So the bond market is quoted in 30 seconds. And what I mean by that is like 30 seconds like the fraction, not 30 seconds like half of a minute. So in other words, the bid price for this bond contract is 149 and 9/30 seconds. So what that equates to, so you might be thinking, all right, how can I use that? What does that really mean? if something is quoted in 30 seconds, it simply means that, well, actually, let's back up even one more step. Let me start fresh. Look at the spread. The spread is one tick wide. The spread is 1 30-second wide. Each point in the bond market, a point here would be 149, 148, 147. There are 32 ticks in every point. Every point is worth $1,000 in notional value. So with a 149 point contract, you're looking at a fairly massive contract here of $149,000 in notional if you trade one contract. So if the spread here is one tick wide and this thing moves in one tick increments, then each tick is 1 32nd of 1,000, which is $31.25. And so the bond market, the /ZB, the long-term bond market, moves in tick increments, and each tick is $31.25. We saw with the E-mini S&Ps, each tick was $12.50. And so this is kind of an example of what I said earlier, in that each bond is its own animal. Or not each bond, each future is its own animal. Each future has a unique set of characteristics that you need to be aware of. And so if I wanted to buy a bond contract, which I don't think I have a bond position on right now, the margin here is even less. The margin here is only $3,700. So you're looking at putting up, what is that, about 2.5%? You're looking at about 2.5% of the notional value for the margin required to trade a bond contract. So again, highly, highly leveraged. The last one that I want to cover is, let's look at crude oil, which is /CL. Now, crude oil is different in a lot of ways. Number one, the first two that we looked at, E-mini S&Ps and bonds, those were financial futures. So remember at the beginning of this video I said every future has an underlying asset, right? Well, for the financial futures, the underlying asset is just a financial asset. So it's not a tangible thing that you can hold on to. But with these commodity type futures like oil, gold, wheat, sugar, orange juice, whatever you want to trade, it's out there to be traded. These things have physical assets underneath them. So it's a very different beast that you're dealing with. And so let's talk about some of those differences. Okay, here's the first one. As is the case with most physical asset futures, you're on a monthly cycle, not a quarterly cycle. So you have a new expiration every month. The oil market is really strange because right now the active month is August, even though it is July and even though it's on a monthly cycle. And the reason why is because I know this because I trade oil futures quite a bit. The oil futures actually expire on the third business day prior to the 25th of the month preceding the expiration month. So that is, definitely rewind that and listen to that again. Because that is why the August futures are being traded in July for crude oil. Now, crude oil, we're looking at $56 right now. So each tick, it's a penny wide market. Each tick is $10. There's obviously 100 ticks in every point, so it's 1,000. So you're looking at $1,000 in every point. $1,000 times 56 is about a $56,000 notional value if you want to trade oil. And so oil is one of the most actively traded futures in the world. And so if I was going to buy oil, it's going to cost me $46.75 in margin. So that's not too bad. The margin requirements here are much higher than bonds. Like we saw, bonds were, what, 2.5%? $46.75 on a $56,000 notional is somewhere around 8% approximately. The reason why the margin requirements are higher for oil than they are for E-mini S&Ps or bonds is because oil is a lot more volatile than either one of those previous two. The oil markets move around. I mean, they whip around significantly. So I strongly encourage you to trade some oil and experience that for yourself at some point before this semester ends. And so if we look at the oil market, you see also the oil market. Oh, well, this is different. So not also. What do you see with the oil market? You see prices rising over time. When you go out in expiration, in terms of going further out in time, you see prices rising. So the oil market right now is in contango. So that just simply means the market expects the price of oil to rise. Now, there are other factors that go into determining these futures prices in terms of, are they in contango or are they in backwardation. There's something in the futures market called cost of carry, and essentially it just has to do with, if I'm short the E-mini S&Ps, I have to pay any dividends that the S&P index might pay. That is a cost of carrying that position. So that is included in the cost of carry. If I have a margin account and I buy a future on margin, I have to pay interest to my broker on that margin. That is a cost of carry. If I buy oil, if you buy an oil contract, if you're long an oil future, you are actually agreeing to take delivery of that asset. Whereas if you short an oil contract, you are agreeing to make delivery of that asset if you're still holding that contract at expiration. Well, if I was going to hold oil, right, if I was going to buy the actual physical commodity, then what do I need to do? I need to store that oil somewhere, right? I need to store it. I need to put it in a warehouse somewhere. I need to insure that warehouse. I need to transport the oil. And there's just a lot of costs that go into carrying that physical asset. And so, the cost of carry could be a video in and of itself. But I just wanted to give you guys another reason why you see these pricing differences from one futures cycle to the next. And so that's it. That's all I've really got for you guys in terms of futures. Again, most of what I went through in this video is from a practical standpoint because our time is limited. And I really want you guys to become proficient at trading these contracts and understanding how these markets move. In my experience, that's going to give you the most beneficial introduction to the futures market that I could possibly give you. So, happy 4th of July, everybody. Have a great weekend. I'll send the midterms out in a few days, and I'll see you guys next time.